So last week we talked about the fact that I thought prices were going to go considerably higher in the housing markets all across the United States. That's what I thought was going to happen. I use a timing model, often tells me what, doesn't often tell me why. So today, let's talk about some of the reasons why this could happen, and maybe it will validate our theory. Let me go to my very first slide and let's start talking about it. Now, this is a review from last week. This is my timing model. I have a proprietary timing model. It's been very, very good. It's based on an 18-year cycle. Now, it's correctly identified both of the mid-cycle corrections that we run into, and right here is the accumulation phase, and I believe we are in the middle of that phase. This is where fortunes are made. So I think we have another 2 years, maybe 2.5 years of accumulation. Now, this is really the best time that you're going to have to accumulate a portfolio of homes, because you're in an appreciating marketplace, a strongly appreciating marketplace. Who wants to be in a depreciating market? Nobody wants to buy when they're heading down. You want to buy when they're heading up. And this is heading up. And I'm going to think we're going to get some acceleration in this, and we're going to go into the explosive phase. Now, again, this is what I see is happening. We're going to explore as to why I think it's going to happen. Now, my timing model tells us that when we get close to the top, we're going to want to quit buying and review our portfolio and sell those properties, that the strategies that we employ are going to delineate which properties to sell. And that's where we come in. We're in the real estate business. We've been doing this. I've done this for 4 decades. I represent a lot of investors, represent a lot of baby boomers, because that's what I am. And we develop good passive income for you. We have all kinds of staff here for you. We've got property managers and repairs and people who are going to rent the property for you, manage it for you, and they'll send you a check each and every month. Now, you can be as involved as you want to be or not involved as you want to be. You can be completely passive. A lot of my investors are completely passive. And you are strictly the investor. You're not the landlord. And we'll send you a check each and every month. We'd love your business. So make sure you understand that this is an advertisement for your business. We certainly want to do business with you. And you can reach me at michael@michaeldeville.com. But let's start talking about why I think this is so terribly good for you. So let's go to my very next slide, and we're going to talk about why I think this is going to happen. Now, some of the terrible things that you've seen in the marketplace is the home buyer sentiment. Well, I'm going to tell you, if you're a first-time home buyer, you are just exhausted. It has just been debilitating to be a first-time home buyer. They are just getting beaten up. Now, in the great markets of Florida, Texas, and Arizona, there are just tons and tons and tons of buyers, but this is all across the United States. So if you're a first-time home buyer, you struggle to get your down payment put together, and we all know how hard that is. You know, you got kids, you got school, you got bills to pay, and you still want to get a down payment together. It's really a hard thing to do. And you are out there competing with guys like me who are going to pay cash, or we're going to put 50% down in an interest rate so we can get under 4%. What a great deal. So if you're a first-time home buyer, you're working against me. This is a really, really hard thing to do. My advice to you is to just keep going, because real estate is a very, very compelling investment. But they get exhausted. And you can see it's absolutely understandable why home buyer sentiment would be awful, because it's awful being a first-time home buyer. It's just a terrible, terrible experience. And the builders are scared to death. They're looking at build 18 to 24 months out, and they want to be sure that they can go ahead and earn a profit, because prices are accelerating so quickly at their end. Not only are producer prices going up, but the finished goods, they're having trouble getting refrigerators and air conditioners and disposals, dishwashers, doors, and glass. But we have a problem with shortage of labor, and they're paying very, very good wages for labor. So if you're in the construction business, you are doing very, very well, and that's also going to add to the fact that why we're going to do well is because wages are going up. People who are working are earning a very very good wage. This is very, very good for the economy. There's going to be lots of money going on because there's a lot of people sitting on the sidelines, and they really shouldn't. They should be actively getting into the marketplace. Even if you're not making as much money as you want to, there's plenty of ability to move up. There's just plenty of work, and you can enjoy employment and earn a lot more money. And this is what's happening. So now a lot of people that are earning money better than they used to are now buying homes as well. So it's kind of a very virtuous cycle. Let me go to my next slide. We can talk about that. Now, this is the Empire State survey that just came out. This is another zero hedge slide, came out in August, and it's talking about manufacturing. Now, if you're a manufacturer, I'm going to tell you, in the last episodes, we've been talking for the last 3 or 4 months that the economy was absolutely on fire, and for you not to expect for it to remain on fire, that it would go towards normal, and that is what's happening. We are slowing down. Now, we're not calling a recession call. We're not saying we're going into a major downturn. We're just saying things are slowing. And of course, if you're in a manufacturer, you've got all kinds of problems. Wonder why they're, we've got lockdown all across the globe. So why would they be so optimistic? When you have lockdown, you have people that can't buy things. They're not working. They're not producing things. And this is all the way from Australia to New Zealand to Europe to Canada. So we've got lumber mills that aren't working at processing plants for beef and pork and chicken. You got the miners in Australia aren't going into the mines. And of course, this is a global thing. So if you're a manufacturer, you're looking at these supply chain problems, and it's kind of hard on you. You're thinking to yourself, man, that's really, really hard. So why would your sentiment be great? However, business is still very, very good. Remember, the PMIs were at historic levels, and they're unsustainable. So of course we expect them to slow down. We expect to go back to normal. Normal is fine. There's nothing wrong with normal. In my business, normal is not putting your home on the market at 9 a.m. and having 20 offers by 5 p.m. That's not normal. So we're going to go to a more normalized market. We're still going to be elevated. Business is still going to be good because we're seeing the millennials come out too, not only the baby boomers, because it's such a compelling investment for baby boomers to be getting this income. It's one of the few places that you can get an inflationary hedged income and a livable income at the same time. And it's conservative, and you can keep it completely passive. It's just a wonderful, compelling investment. But millennials are going into their home formation and their family formation years, and they're looking to buy homes, and they're coming into their own too. So a lot of these millennials have 2-income households that they're making 6 figures, and they're able to purchase homes. It's just a wonderful thing, but we run into supply constraints. And what do you expect when you have supply constraints? So let me go to my next slide, and we'll talk about that. Now, if you follow my work in March and April and June and May of 2020, we had the stimulus that went out. There was $6.3 trillion. I mentioned the fact that the most liquid markets were the ones that were going to perform immediately, and that was the stock and the bond market. The stock market took off because all the liquidity went into a liquid market. Now, when you have this kind of money coming through, it takes anywhere from 9 to 18 months for it to filter down into Main Street, and that's where the real estate industry would see that, and that's what we've seen. In the last 12 months, we've had home prices here in Maricopa County go up 39%. Now, that's all across America, but of course, in the great markets, not only are you getting inflation, but you're getting an organic growth component in Florida, Texas, and Arizona. Now, if you do not need to be purchasing in your home market, you can find, if you want to purchase in Florida or Texas and you happen to live in Minnesota, you can certainly do that. If you want to purchase in Phoenix, we're here to help you. We've got a whole structure. Now, why am I so excited is that they just passed this $1.2 trillion infrastructure bill, and $3.5 trillion more is coming on top of the fact that the Federal Reserve is doing $1.2 trillion in bond purchases and mortgage-backed security purchases a year. So we're going to get another $5 trillion in stimulus on top of an economy that's inflating. What do you think is going to happen to prices? What do you think is going to happen? And if you think that you don't have to worry about your purchasing power, I think you need to talk to your financial advisor. Buy a real estate rental. It's great inflation hedge for yourself. Let me go to my last slide. Now, I'm going to come off my soapbox here a little bit. Now, this is talking about prices received, new orders, and new employees. And you can see here we're slowing down. Now, we've been talking about we're going to slow down. Not a recession, just slowing down to normal. But look what's happening to prices here. Do you see anything really unusual here? We had a little bit of slowdown, not much. So here's our latest numbers. Prices are going up fast. They're going up really fast at the producer price level. And look at this. Look at this spike. We've talked about this spike before. There is no slowdown to producer prices. And this is going to be reflected in everything you buy. So if you have a major purchase to buy, now's the time to do it. If you're going to buy a car, now's the time to do it. If you're going to make a major purchase, this is it. You're going to buy furniture, flooring, whatever it is that you're going to do, you want to do it now. And if you have a concern about income, you really need to do that now. You know, prices are going to continue going up. So yes, prices have gone up, but they're going to go up higher. So this is a type of market. This is why it's called the accumulation phase, because it's an appreciating market. You want to buy in a market that is going up. Everybody says, oh, I'm going to wait till the prices come down. You want to buy when they're going down? Why would you do that? That just doesn't make good business sense. You want to buy prices that are going up. You want to make capital gains. This is what we do. Now, we have strategies for all this. I've done it for 4 decades. I would love your business. I have a very good staff. We are very good at what we do here. If you want to talk to your wife or your spouse, your best friend, your financial advisor, we're more than happy to discuss it with you. If you like my videos, give me a big thumbs up. You're welcome to subscribe. We'd love your comments to find out what your thoughts are. If we're explaining ourselves and our thoughts come out clear, if there's something we can do better, we'd certainly like to listen to that. And you're welcome to reach me at michael@michaeldouville.com. My best to you. Bye-bye.